Hello and welcome to Bondcast Speakers Corner, our new series where we bring you conversations from experts at NatWest and beyond to deep dive into some of the topics moving rates markets. Don't worry, our weekly Friday episodes will still be published, but these ad hoc episodes will give us the opportunity to get into the detail of some of the things on our minds. I'm your host, Imogen Bachra, and today I'm joined by James Bucknall, our Head of Sterling Interest Rate Trading, and Iain, Budge, Head of Banks and Building Society Solutions. Very excited to have you here for our first episode. I thought, given a lot of the focus that we've had over the last couple of weeks around, well, lots of different elements, the growth agenda in the UK, the state of the fiscal position, who's going to be buying all of the debt that the UK government's going to be raising over the next couple of years, and also what ways there might be to look at increasing demand from some sectors for those gilts in the UK. We've increasingly been talking about regulatory changes and most recently the leverage ratio framework. So it made sense, I think, to get both of you on today to deep dive into that, something that we don't have the opportunity or time to do in our regular podcast episodes. I gave a little bit of an overview there, but Iain, perhaps it's best to start with you and you can kind of introduce why we're even talking about this in the first place or why it's become a bit of a topic in UK rates markets.
Sure. So I guess leverage ratio has been mentioned a few times recently. We have the FPC due to report back on any changes to the leverage ratio in July, which is obviously coming up shortly. We also had a consultation on the UK Treasury Bill market, the results of which revealed that some of the respondents suggested excluding T-bills from the leverage ratio to promote secondary market liquidity. And we've recently had changes to the supplementary leverage ratio in the US at the start of the year, which has, I guess, prompted some of this conversation. So I guess one of the main factors that leverage ratio impacts is investment in low risk weight assets, as leverage ratio can be a kind of binding factor there. And when we think about low risk weight assets, gilts is certainly one of those for UK banks. So when we think about what might change with leverage ratio and banks' ability to invest in various assets, gilts obviously comes to the fore.
Let's take a step back and just, I think for a lot of our listeners, it would be worthwhile maybe just defining exactly what the leverage ratio is and why and how it matters for the gilt market.
Banks and building societies in the UK have to hold capital. There are essentially two capital ratios that they have to adhere to, which define essentially the size of their balance sheet and their lending operations. The main one which people know about will be total capital ratio, which is based on the risk weight assets of their lending book, amongst other things such as derivatives and securities financing transactions. So banks have to hold capital in relation to how potentially risky their lending operations are. The other one is leverage ratio. And I think the thing to remember about leverage ratio is it's not supposed to be a binding constraint. It is introduced to be more of a backstop to stop too much leverage across the system. And it's a crude calculation, essentially capital, of which it can be different types depending what jurisdiction you're in, divided by exposure, which is a combination of on-balance sheet and off-balance sheet exposure, off-balance sheet being things like repos and derivatives. So essentially it's not a risk-sensitive measure, and hence if you have a relatively low risk weight lending book, you may be constrained by leverage ratio, which may not be the kind of regulator's intended consequence.
When we're talking about ways in which the leverage ratio might be changed, what changes might we be talking about? And then we can go on to think about what the impacts from either an economic or a markets perspective might be.
Sure. So in the UK, central bank reserves are exempt from the leverage ratio for UK banks at the moment, whereas in the US, there has at different times been exclusions for treasuries as well as central bank reserves during COVID to improve the functioning of the treasury market. The leverage ratio itself is usually made up of depending which jurisdiction you're in, a minimum amount of leverage you're allowed to have, plus essentially buffers on top of that. And these can be amended at time to time depending on the regulator's decisions. So in the UK, the FPC, the Financial Policy Committee, makes recommendations to the PRA around the level of the leverage ratio, as well as what is in the exposure for leverage So there are various different things that could be either excluded from that exposure calculation, or the absolute level of leverage can be adjusted due to financial conditions.
When we're talking about things being excluded, I suppose the reason that we've got, or that we're thinking about this a bit from a market's perspective is, you sort of alluded to at the beginning about this T-bill consultation and the potential for the exclusion of very short-dated gilts or T-bills, or, even taking that one step further, we're thinking about the potential for the exclusion of gilts as well. What's your take on the likelihood or what impact that could have?
Yeah, so I think sometimes people think about T-bills as relatively fungible for central bank reserves, given their short-term nature and their kind of low risk sensitivity to interest rates. As I mentioned, there's obviously been a T-bill consultation where that was suggested as a potential outcome to help secondary liquidity in the T-bill market. So I guess one option could be to consider removing exposures to T-bills or short-dated gilts from the exposure metric for leverage to promote further liquidity at the short end of the gilt curve. You could take it a step further, such as the US did during COVID, and remove all gilts from the leverage ratio exposure. That could promote, I guess, further demand from bank treasuries and potentially improved secondary market liquidity, albeit secondary market liquidity is pretty good in gilts. But that could, I guess, shift the demand equation for gilts. And I guess then the third option is you actually amend the buffers on top of the minimum leverage ratio requirement to bring that down, and that would then impact, I guess, asset growth in general. So that would be across more loan products as well as investments in gilts or other HQLA assets. So other HQLA assets being assets that banks hold to meet their liquidity coverage ratio.
James, I'm going to bring you in a second to give us some context around how important that bank treasury demand for gilts and potentially bills is and could be. But maybe before we do that, Iain, if thinking about those potential changes, whether it be that they could exclude bills, they could exclude bills and all other gilts as well, or potentially change the buffers, what would you assume would be the most likely outcome? And also, I think quite importantly, on what kind of time horizon might we be talking about this? Because obviously, like you say, the Financial Policy Committee, the FPC, committed in December to review the leverage ratio framework, and they're due to meet again in July. So there's sort of lots of excitement that we could get meaningful changes as soon as July. But how likely do you think that could actually be?
When you look at the FPC objectives, one is obviously financial stability, but the other one is economic policy as a second objective. When you consider the potential changes that could be made, you could make an argument probably that all of them would achieve an objective for the government. In terms of likelihood, we've seen that the US looked at the exclusion of treasuries from the exposure metric for leverage ratio, and they instead ended up amending their supplementary leverage ratio to promote secondary market liquidity in treasuries. So you can see that they felt that you didn't need to necessarily exclude the bonds from the leverage ratio exposure calculation to get that outcome. So it could be the case the FPC decides to go down that route, in which case it may well have impact on the gilt market in terms of that becomes a potentially more interesting investment for banks. Mm-hmm. But similarly, they could utilise that capacity to make loans into more low-risk mortgages, or they could buy other HQLA bonds because they can buy things like RMBS, covered bonds, supranational paper. So they've got a range of other assets they could look to buy, so it may not be exclusively felt in the gilt market. I think the other thing to remember is when banks and building societies buy gilts or fixed rate bonds, they traditionally tend to manage their balance sheet on a floating rate basis, so they don't run maturity mismatches. So essentially they end up buying bonds on asset swaps, and that is a market that clearly moves, and James will talk about that shortly, but there is not an unlimited amount of asset swap spread risk that treasuries will be willing to run, mm-hmm. even at attractive levels. So that is, I guess, a consideration. In terms of shorter dated bills versus longer dated gilts, it depends on what objectives the FPC are trying to solve for.
Mm-hmm. James, maybe that's a good point to bring you in there, because I think we could take one step back for a second and just think about how important that bank treasury demand actually is in the gilt market at the moment. We talk a lot on Bondcast and offline. We talk frequently around those kind of supply-demand dynamics in the UK, and there's obviously been a big shift away from kind of traditional pension fund buying and a bit more overseas, a bit more hedge fund buying as well, as Iain alluded to. But how important is that bank treasury as a source of demand for gilts?
Yeah, I mean, it's always been important, but over the last couple of years, it's become even more important. And it does tie in with what the DMO have been doing over the last couple of years in order to sell the gilts that they need to do to raise the money that the government needs. And it's pretty well understood that over the last few years, there has been quite a significant reduction in the weighted average maturity of the gilt issuance, basically because of the size of what needed to be sold, the level of yields which were being demanded by investors for longer dated paper, and a sort of structural reduction in the demand for long dated paper from, for example, pension funds. I think that's all very well understood and very much in the price. Where I think this gets really interesting, and the conversation around bill issuance is that, for me, there is the potential that we have a further shift shorter in the weighted average maturity, and that bill issuance takes up a much larger proportion of the of debt issuance. Now, I'm not going to go into whether that's a good thing or a bad thing, but the reality is that when participants are particularly negative on the outlook for gilts, given a requirement for more gilt issuance, if that comes in bills, then you might perversely see less issuance and less DV1, less risk hitting the market, which could actually be gilt positive. And that clearly, this consultation didn't happen by accident. There's whether it's the Treasury or the DMO want to explore what would be necessary for a significant increase in bill issuance, and to have not just a liquid secondary market, but primary dealers participating in that issuance in the first place. And there were a few things that came out of that consultation, which I think were relevant. The first one is that although the gilt market is liquid, the bill market, the secondary market for UK bills is less liquid. One of the reasons for that has been that as a dealer, it's very difficult to sell something that you don't own and then subsequently go and borrow it from someone else. There isn't really a liquid repo market for bills. That was something that came up in the response to the consultation, and measures are being put in place to address that. But further, and tying in with who's buying all these bonds, it does consume a lot of balance sheet to warehouse positions in bills to create for market makers to create that secondary market. And that was another key thing that came out of the consultation, was a request, I guess you could call it a request, from participants, market makers, to say, if you want us to hold warehouse positions, it needs to be more economical. And that ties in with do they contribute to the leverage ratio? Because that's just one of the constraints that we have, or participants have as institutions, whether it's risk limits or balance sheet limits, things like that. If those are relaxed, then it facilitates a more liquid secondary market. Although there have been announcements on the sort of repo side of things, or the lending side of things, for potential increase in bill issuance, the leverage side of it hasn't yet been addressed, but it's clearly been something that is being talked about. And it could be quite a dramatic change to the market, not just from the shortening of the weighted average maturity even more, but also the ability for banks to then use that leverage capacity in other ways.
I guess this is going a little bit off on a tangent relative to the leverage ratio framework question, but it's a lot to do with the bill consultation. And when we think about the way that, potentially the DMO is significantly shrinking that weighted average maturity by doing a lot more of bills, how much do you worry that it will actually, doing much more bills will just cannibalize demand that's already out there for very short dated gilts? So it is doing more bills really unlocking a new pool of demand for the DMO and another sort of diversified source of funding, in a way, if you like, or does it just take away from what already exists at the short end of the gilt curve?
I think that when we talk about the sort of sub 1 year part of the gilt curve, that then goes into where bills are issued, the consistent feedback from, for example, the quarterly meetings between investors and market makers with the DMO, and the annual meetings with the Treasury, are that there is a lot more capacity for for increased bill issuance. So I feel like there is the capacity there, and I don't think it cannibalizes demand further out. It's a different investor base, and I think there are a number of reasons why you can be positive on gilts.
Thinking a bit about the kind of potential regulatory changes that could help to improve liquidity in the bill market. I guess there's a question, and we touched on it with Iain just a little bit ago around, well, there could be leverage ratio framework changes that treat bills and gilts differently. The US, they were talking about changing their leverage ratio framework to the end of improving liquidity in the Treasury market. And we're talking about it now in the context of bills as well. But do we have that same kind of need in the gilt market to look at regulatory changes to support liquidity, or is there quite a distinct need in the bill market versus the gilt market? And therefore, does that influence the way that you think about potential regulatory changes and treatments of bills and gilts?
I actually think the gilt market is pretty resilient, and so I don't feel a desperate need for any relaxation to support secondary market liquidity in gilts. I think everything is working really well, actually. And in fact, just to go off on a slight tangent, what we saw over the events in March in Iran was that although we saw a significant increase in interest rate volatility, both the short end and the long end of the curve, we've had an increase in gilt volatility around, let's say, fiscal concerns or political concerns. The actual funding part of the market has been really, really resilient. It was sort of like a nothing to see here. But the bills do stick out as there isn't really a liquid market, and why isn't there, and what is the benefit to the UK of having a more liquid market, and the ability for the Treasury to fund that way, and a DMO to fund that way if they desire, as opposed to funding at what generally seem to be pretty unattractive rates. When you look at the level of long end yields, and particularly long end real yields, it doesn't feel like those are really sustainable, and that's been a big thing that I know you have spoken about. I'm not a fan of this doom loop scenario, but at the same time, if you continually fund at levels that you probably can't grow at, then that's not ideal. And I think this could be a way of getting around that.
I think the point around sort of financial stability that you make is important as well, because we have had this big shift in the gilt market. We do have a lot more leverage players that are a lot more involved now than they were previously, and that's something that the BOE have been focused on. Catherine Mann just a couple of weeks ago made a speech around the impact that can create in terms of creating volatility in the market. But to the extent that we've just been through I don't know if crisis is sort of overdoing it, but a sort of crisis period within markets, and actually, like you say, funding markets remain well contained, very well behaved. Perhaps that speaks to the fact that we don't need to see these big regulatory changes to support the gilt market even further. Iain, would you think it's possible that you could see separate treatment of bills and gilts within potential changes to the leverage ratio framework, or are you thinking that actually we shouldn't be thinking about ways that they change the exposure measure? It's much more potentially about ways which they can change the buffers, and therefore they could be treated in the same way.
All options are open, to be honest, and you can make an argument for all of them. I think the thing to consider is around whether particular sectors or areas need support. You just talked about the illiquidity of the T-bill market in particular, or whether kind of more wholesale reduction in the kind of leverage ratio suffice to solve some of those issues, plus potentially provide the benefit of kind of real economy lending, I think is the way to think about it. If you look at what the way that the US addressed it, it maybe points towards the latter, i.e. just a reduction in leverage ratio levels, or reduction of the buffers on the minimum leverage ratio. But, as I said, you could definitely make an argument for all of the routes we discussed.
You sort of have briefly touched on A, the real economy lending impact, but then B, also what it could mean in terms of subsequent demand for gilts. So in the most extreme scenario, let's say, just for argument's sake, that they exclude bills and gilts from the exposure measure, and they reduce, tweak, remove the buffers. How much is that currently a constraining factor on bank demand for gilts, and therefore, how much could this meaningfully shift the way that banks are thinking about buying gilts I think you touched on it before around the range of other assets that are available, and it might be more meaningful for some banks than others. But is this really, could it be a game changer, or are we getting a bit ahead of ourselves?
As I mentioned at the start, I guess the leverage ratio is not supposed to be binding constraint, but because of the average risk weight of primarily the lending that the UK banks and building societies have been doing, the leverage ratio has become a constraint at points for a number of firms. Hence the requirement to address it, or at least to consider addressing it in July by the FPC. Therefore, you get to a stage where you consider that firms aren't perhaps able to invest as much into gilts or just assets in general outside of the reserve account that they'd perhaps like to, based on return on equity metrics. So therefore, when you either exclude certain asset classes, gilts or T-bills, or reduce the minimum amount of leverage, you then remove that leverage constraint and you go back to thinking about the return on the equity, return on risk-weighted assets, and therefore you view investment in gilts or T-bills alongside potentially lending into raw loans if it's a general relaxation of the buffer. If it is just an exclusion of particular asset classes, gilts or T-bills, you then need to work out the, I guess, returns on those particular assets and how much risk you're willing to write. If firms have large gilt books already and the gilts are removed from the exposure metric, you might actually find if they're comfortable with the volume of gilts they've currently got, that they therefore might actually move into other HQLA qualifying assets. So that is high quality liquid assets, of which would qualify for their liquidity coverage ratio outflows. So therefore you could find some of the demand spilling over into covered bonds, supranational bonds, agency bonds, RMBS, autos, credit cards. There are a range of other things that they can buy. They are smaller asset classes. They are less liquid asset classes.
In the scenario where this does generate some bank treasury demand for gilts, where on the curve do you tend to see those flows? And would this encourage to any extent, an extension further out or keep the very front end? Where would you expect to see the biggest benefit?
That's an interesting question right now, because there is a decent amount of what you could define as term premium in the gilt market because of, I guess, political concerns. Those concerns and uncertainty and higher levels of expected interest rate volatility as a result are one of the things that is preventing people from buying more gilts. So in that sense, you are paid to extend on the curve and take that risk. And that is something that a banking book, a non-mark-to-market banking book, is there to do, really. So the question is, well, how much are you paid and is that good, and what are the constraints? Now, just to pick up one of Iain's points, was that the leverage ratio isn't a binding constraint to everyone at all times. However, it is definitely the case that we hear of a number of market participants who periodically are constrained by leverage, and that is stopping them from buying more gilts, even though they look attractive. So it follows to me that improvement or relaxation of the leverage ratio constraint would result in a higher demand for gilts. And when I say higher, that's increasing or pushing longer on the curve. So, and this sort of segues into another critical part of the equation for me, is that the Bank of England has been very, very clear on its view that the preferred minimum level of reserves is higher than it was, and that as assets are moved, gilt assets are moved from public to private balance sheets via QT sales, that the repo facilities should take up that required increase in reserves. And there are various things that have been put out by the Bank of England, very clear that this is a feature, not a bug, and specifically the Bank of England's weekly short-term repo facility and the growth in that. What that means in practice is that market participants like domestic banks can feel very confident that they can fund gilt purchases with the Bank of England at a rate close to the base rates. Now, we started off the conversation with thinking about things in what we would term asset swap space, so not gilt yields per se, but the spread between gilts and the risk-free rate. And At the moment, we're seeing the implication of those funding facilities, and short-dated gilt yields are very, very close to bank rate or SONIA. However, as you extend out further out on the curve, you get to sort of the 10-year maturity, where 10-year gilts are about 50 basis points cheaper than the risk-free rate. So if you're very, very confident that you can fund gilts at the risk-free rate for the next 10 years and you don't have to suffer the mark-to-market volatility, then there is 50 basis points of money there and pickup to be taken. And I think the leverage constraints are one of the constraints which prevents people from doing more and extending longer. And so if that's relaxed, then I think people extend longer and probably buy more.
And I think that sort of brings me nicely onto what was going to be my next question, because it is an important consideration when we think about the fact that the Bank of England, even just this past weekend, Bailey was in the Sunday Times talking about how doing QT is the right thing and they want to continue to do QT. And we sort of have evidence, we think, that we're encroaching on that preferred minimum reserve range. They want to continue this transition to a repo-led framework system of supplying reserves. They need the banks to be able to buy the gilts for that to continue to shrink the balance sheet. And even though they talk about maybe being near the preferred minimum reserve range, they've talked about QT, I think, even going beyond that, so that they're continually shrinking the gilts that they own on their balance sheet, and they have to sort of transfer that risk into the private sector, which presumably at some point will require the banks to be buying even more than they are now.
Yeah, and of course that could come through with gilts just get cheaper, and then people buy them. But I don't think people necessarily want that, and I don't think the market requires that. So there are other things that the bank and the Treasury can do to facilitate that transfer of assets and maintain that higher level of reserves.
Are there other things that you're thinking about beyond what we've discussed here in terms of changes to the leverage ratio framework?
The changes to regulation and the leverage ratio are probably the main thing that we're focused on as having a potentially big impact on the demand for gilts going forward.
Okay, well, on that note, we've probably deep dived enough on the leverage ratio framework and the potential market impact. So thank you both for joining me today. It was great to get you on and great to have you for this first episode of our Bondcast series with guests. We've got lots of exciting episodes like this one lined up with some in-house and potentially external experts as well. So if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available.